I want to thank all of you for attending and joining us for this quarterly update on REIT performance for the third quarter of 2025. That's what we'll be discussing today. My name is Mike Consol. I'm your host. I'm editor of Real Assets Advisor magazine, one of 6 titles published by Institutional Real Estate Incorporated, which is co-producing this webinar along with Nareit. Nareit, of course, is the National Association of Real Estate Investment Trusts. Nareit is being represented today, as always, by John Worth, Executive Vice President of Research and Investor Outreach for the organization. Also joining the discussion, our guest, Keith Bokota. He is Portfolio Manager and Head of the Americas at Principal Asset Management. Now, audience members, we are inviting your questions in writing. And those of you who are repeat attendees know that those questions get integrated into the questions I ask our panelists. So we, as much as possible, try to answer them in real time. So please submit those questions. We look forward to getting those answered for you. Also, a recording of this webinar will be sent to everybody who registered for the event, whether they attended or not. They'll get a copy of that. And the webinar will be published on both the IREI and Real Assets Advisor websites. John Worth and Keith Bokota, welcome to both of you.
Thanks, Mike.
Thank
Great
you.
to be back with you.
Yes. And we've had some action in real estate during the past quarter. And John, we'll do our usual, which is to have you kick things off by giving us the rundown for the quarter. How did REITs perform during third quarter 2025?
Thanks, Mike. Happy to walk through it. And another exciting quarter in REIT land, I would say. The net of all that was a positive quarter. REITs were up 2.7% in the third quarter, putting them up 4.5% on a year-to-date basis. And they've been positive in 2 of the 3 quarters so far this year. As we'll talk about, REITs are having a moderately positive year on a year-to-date basis, but when compared to broader equities, are trailing broader equity indices by upwards of 1,000 basis points, depending on the index. So, a bit of a question mark in terms of valuation of REITs versus broader equities that I'm sure we'll hit on. When we look at the sectors, we can see that again, quite a bit going on. And you can see on the left-hand side, we've got the year-to-date returns. On the right-hand side, we've got the third quarter returns. Leading both, you can see healthcare up 26.7% on a year-to-date basis, and a very strong third quarter up 14.8%. Interestingly, in part driving that, in part as a result of that, we now have a healthcare REIT. Welltower is actually the single largest REIT in the world, with a market capitalization of over $125 billion. So that's kind of a new and unique feature. Following healthcare, you can see diversified, which is quite a small sector. It's just about 3% of market cap in the REIT indexes, but having a strong year up 20% and a strong quarter up 9.9%. And then you can see gaming up 12% on a year-to-date basis, although sort of a modest quarter up just 1.4% for the quarter. And then retail and industrial both up about 7% on a year-to-date basis. Both had good returns for the quarter, up 8% and 7.4% respectively. And I do think this is in some ways one of the interesting stories in terms of sectors that earlier in the year look to have concerns with respect to tariffs, but have actually shown themselves to be quite resilient in terms of both operational as well as stock market returns. And then down there at the bottom of the table, in terms of underperformers, you can see data centers down 9.6% on a year-to-date basis. I know later we're going to get into what's essentially been a little bit of a disconnect between REIT stock prices, or appears to be a disconnect between REIT share price movement and the overall enthusiasm for the data center space that that you sort of see in the papers every day. And then lodging down 9%, but with a good bounce back quarter in the third quarter. And then perhaps maybe the most interesting dynamics for the quarter, telecommunications, which is sitting up 6.2% on a year-to-date basis, but was down more than 11% in the third quarter on some very interesting supply news. Lastly, I'll just turn to some global returns, just to give a perspective on where the U.S. and North America sits relative to the other regions of the globe. This is in dollars, so that has a meaningful impact on the Asia and developed Europe returns, as the dollar has declined significantly against those index currencies. But you see, when we look globally, we see North America up 4.9% on a year-to-date basis, developed Asia up almost 28% on a year-to-date basis, and developed Europe up almost 19%. And this is a really unique year. It's fairly unique for the U.S. not to be the best performing region in the global index, and it's very unique for the U.S. to be in the third position. So and part of that, of course, driven by the dollar's decline. Just noting a couple sectors in particular where you can see healthcare, very strong returns across the sectors. The healthcare space is much larger in the U.S. than it is in Europe and Asia, and you can see the diversified sectors in Asia and Europe, which are much larger shares of those respective regions at over 60% for Asia and over 30% for the Europe, but both performing quite well. So with that, let me stop sharing and we'll jump into the conversation.
Yeah, John. So healthcare, I mean, leading the REIT index is such a controversial subject, so reviled in a lot of quarters, and it's even the cost of our current government shutdown, one could argue. But obviously performing well on the REIT front. What's the buzz with that sector? Why is it busting out so big?
Yeah, and I think it's important to note, right, the healthcare REITs not providing healthcare, rather providing the real estate that houses healthcare providers of different types, ranging from medical offices through skilled nursing, and then into senior housing, which is really, I'd say, in some ways adjacent to healthcare, not necessarily housing healthcare provision directly. And I would say that it's really senior housing that has driven the story for healthcare this year. And to me, it's an interesting story and one that I think we may see some echoes of in other sectors. But this story, for me, for healthcare, really starts on the supply side, and you really have to go back to 2020. Starting in March 2020, very few people broke ground on senior housing facilities. In fact, they went through a pretty tough time in terms of occupancy. And we're really seeing, and then following that, obviously, with increasing interest rates, that has really diminished or kept the supply in the sector tamped down. Well, demographics moves on. And so whether we like it or not, we all got older between 2020 and the present, and our population got older. So that over 80 population, that really is kind of the sweet spot in terms of demand for senior housing, continues to be one of the fastest growing age cohorts in the U.S. So we've seen demand continuing to increase and very little supply coming online the last couple of years, and that has worked out quite well for the owners of senior housing, including the REITs. And I think something that sort of we certainly ponder is, given that we've seen slowdowns in starts across a lot of sectors, you do sort of ask, are we going to see many echoes of this in other sectors over the next couple of years as we see demand continue or pick up and lower supply across a number of sectors?
Yeah, the silver tsunami has begun, John. No commentary on your head or mine, but it's clearly underway after a long delay. It's like, when is this going to happen? But it is definitely happening. seeing a lot of reports these days talking about now is the time for investing in senior housing. Hey, Keith, what did you see on those performance metrics that maybe stood out to you or you consider noteworthy?
I mean, I first just to echo what John said, some of the tailwinds that healthcare is seeing, and even just the reports we've been getting out of that the seniors housing property type more recently have been very favorable. We're seeing occupancy growing at above normal seasonality paces. We're seeing strong rental growth from that property type. And John mentioned it. It's one of the really important things is looking at the supply, and we're actually at pretty record lows in terms of the supply that's getting added to the market in terms of the seniors housing property type. You really have to go back till 2010, 2012 before you saw these types of levels of supply, despite us being on the cusp of a strong acceleration in that 80 plus cohort. So yeah, I would call that's definitely been one. Another interesting, I think, dynamic that we saw during the third quarter was just what happened within the office group. Office was a bit of an outperformer during the quarter. I think there was a bit of investors were more comfortable taking risk, but even looking within the group, there was quite a bit of divergence within office. And I would say that largely probably reflected some rotation. So last year, we saw the New York office names have quite strong performance. And I think, fundamentals on the ground in New York remain quite healthy. We're seeing, in Midtown or, some of the largest submarkets, we're seeing vacancy levels at very low levels, but that's a known story to the REIT market, REIT investor base today. And what has been more surprising in 2023 is we've started to see some green shoots on the West Coast. And so we've seen a real pickup in leasing activity. That market is still far from stabilized. You look at availability rates, vacancy rates, they're still quite outsized, 35%. But we have seen increased confidence that fundamentals are bottoming. And we're starting to see a bit of a pickup from, AI gets talked about a lot, but we're starting to see some more AI demand. That's going to be an important piece of the puzzle. It's likely not going to be the whole piece of the puzzle that stabilizes that market, but we're seeing some encouraging trends there as well.
Question from our audience, from a gentleman named John. I want to give you his last name only to say that he is a real estate mogul himself. He's asking, why would U.S. lodging be underperforming developed Asia and Europe by such a wide margin? John, there is the whole thing going on with tariffs. There's a lot of bellicose language coming out of the United States, some would argue, and that we've kind of turned some people off around the world who have decided, including the Canadians who say, I'm going to travel somewhere else this year, not the United States. Is that at play at all? Because I've heard that some reporting in the Wall Street Journal, I believe it was the Wall Street Journal or The Economist, indicated that's been overblown.
I think that you've got two things feeding into into lodging. I think one, you do have concerns about will international tourism decline. I think maybe the jury's out on that. There's a lot of anecdotal evidence. I think we'll kind of see how that emerges over the next 12 to 18 months. I think you also have concerns about, the state and health of the U.S. economy, right? Sort of both business travel as well as leisure travel sometimes are the first to go when budgets tighten a little bit. And so I think there's concerns about both of those. In Europe and Asia, I think you've got there are a little bit of more of emergent sectors. So there's some newer names playing in there that might be feeding into some of the performance. The other thing that I just caution about looking at the hotel sections in Europe and Asia is they're quite small as a share of the total market capitalization. Sort of about 1% to 2% of the total market capitalization. So not necessarily large portions of the market cap. So they can get moved around by one or two names.
Gotcha. So Keith, just your impression. You're in Chicago. which is a quite a tourism city. Do you happen to know nationally what our statistics are looking like, Keith, in terms of are we? I mean, it seems like a very strong time for tourism. It seems like a lot of people are traveling. I don't know if you have any metrics at hand, Keith, but or some just your own observations.
Yeah, I mean, I would say, one of the things that's happened in the lodging space is, international tourism. I think it has taken a step back. There's been more domestic travel abroad than inbound. So I think that's been a theme that's impacted a lot of markets, including Chicago. But one other thing I'd say is we've seen some bifurcation within that property type, where if you look at the luxury segment of lodging, that's a segment that's actually doing quite well. But it shares some similarities with retail, that the lower end consumer has been more pressured by inflation, and we're seeing some weakness in that kind of that the chain scales that are not as focused on kind of high end spending. So I think we've seen that really across markets in the U.S.
Gotcha. One of our attendees named Margaret. Margaret, you're asking if you can get a handout from this webinar. Actually, as I said at the top, you will get a link to the webinar. So you will get that. It won't be a physical handout, but because of the miracle of artificial intelligence and such, you can always just play it on your laptop and tell your Word file to turn it to text if you wanted something that physical. So you will be getting a handout of sorts. It's electronic.
And Mike, we do circulate the PDF of the slides along
There you
to all
go.
attendees as well. So if you're not ready to put the video all into ChatGPT and see what comes out the other end, we'll send you the PDF.
Yeah, there you go. All right, thank you, Margaret. And John, can we talk data centers a little bit? I mean, everybody obviously they're smoking hot. They're underperforming year to date. Cell towers performed poorly in the third quarter. What can you tell us about those are two aspects that you think would be performing very robustly, but I know it's a short time frame, but what's going on?
Yeah, it's a very interesting dynamic because I do think a lot of times sort of we'll meet with investors, we'll show them these year-to-date returns. They see data centers down at the bottom, and they sort of almost fall out of their seat because they just finished reading an article about how data centers are the hottest property type, and another 10 billion has been raised, and there's definitely a divergence of a sorts in there. And I think that when you look at data center returns for the year, I see there's really kind of two turning points for the year. The first was early in the year when we had the DeepSeek announcement, kind of suggesting that it was possible to train large language models with significantly less compute power than maybe had been assumed. And that definitely led at least participants in public markets to ask the question, how much AI-driven demand was there going to be there in the margin? Not that there wasn't going to be a lot more. Some people have used the analogy of, is the demand increase? Is it like an extra large pizza or just a large pizza? So you still have a lot more, but the question is it as much? And it is important to note when you think about the data center returns that the negative returns this year are following on 25 and 30% positive returns the prior 2 years. So there was a lot of sort of demand growth priced in. That said, the other impetus I think has been some as the data center REITs have sort of announced their CapEx plans. I think that there's been a little bit of pullback based on those. And curious Keith's thoughts. I think part of that may reflect generalist investors who maybe aren't accustomed to hearing about accretive stock issuance and accretive CapEx, because I think most of what the data centers are announcing, it's development plans that they believe can be very profitable. But we did see the stocks really move negatively on those announcements. So it's a little bit, it is a little bit of a conundrum, I think. Interestingly, just in the last 2 weeks or in the last week, we had an IPO of a new REIT that is focused purely on development of data centers. It's a bit of an innovative model, but definitely a development-driven data center. And it was a very successful IPO with a large bounce post IPO. Some of that's gone away, but so I think I think we're seeing that generalist investors are maybe struggling a little bit with understanding the exact nature of what data centers offer. That said, when we look at active managers, well, we see they've moved their allocations to data centers around a bit. They're still quite overweight in data centers, so they're holding data centers well above the index weight, which is close to 10%.
Mm-hmm. Mm-hmm.
Yeah.
So go ahead, Keith.
I was going to say, our data center universe in the public markets has shrunk in recent years because there's been a tremendous amount of M&A. Good to see the IPO last week, which gets us back up to, I guess, three data center companies that are public. But just maybe following up on some of John's comments, in terms of kind of the rampant development spending and maybe some of the noise that caused for the sector, we've seen this before. It's public investors have a hard time trading near-term pain for long-term gain. We've seen that just in that property type specifically. Anytime there's been a kind of a larger development ramp, that does come at the expense of some increased cost while those developments are underway. And sometimes it's taken the public markets a little bit longer to get closer to the points where those value creation events are going to start more meaningfully contributing to earnings. So that's one thing. And I would say, I think another thing that has weighed on the data center space year to date in the public markets is John's absolutely right. You really can't open up the paper without seeing reports of a new data center project announced. But as far as the public markets go, they're not always participants in that because a lot of that activity is actually happening in secondary markets and tertiary markets, and the REITs have remained pretty disciplined and continuing to focus on primary markets where there's more fungibility to the demand profile. And so, I think that's probably impacted the group as well, because in a lot of those primary markets, frankly, they're less than 2%. There's less than 2% vacancy, and sometimes leasing is just declining because it's a function of there's not space to lease.
Yeah. Well, along that kind of theme of occupancy and pain and gain, Keith, we have one of our attendees saying, has the office market bottomed out? Vacancies are still very high. It was you or John had alluded to office earlier. We see it seems to be a little bit of a patchwork. It seems that in some cities, office is doing quite well. In other parts of the country, it's not doing so well. What's your take on that question? Has office hit bottom, or is there still some more pain to be absorbed?
Well, I don't think it's a uniform answer across the space, and I'm probably repeating comments I just made a few minutes ago. I think New York has already bottomed. If you look at kind of what's going on occupancy levels in New York, for the broader market, I think they've stabilized. I think REITs are outperforming the market and have recovered to reasonably close to pre-COVID levels. So I think they're past the bottom. But I mentioned West Coast markets earlier, and it's not entirely clear that they've bottomed, but it certainly feels like there's some encouraging trends going on there. But it's going to be bumpy. Anytime you have 35% availability, even when there's flight to quality dynamics, I think just conditions are going to be choppier, and rents are going to move around a little bit, and you need to have the right product with the right amenity package that's going to kind of meet the demands of tenants today, which have increased. A big focus from employers is driving return to office dynamics, and the way they're doing that is by really elevating the quality of their office product And so that's where leasing has been the most active.
Gotcha.
And Keith, just to add on to that, because I'm sitting in Washington, D.C., where we have plenty of vacant office space, more than usual this week, but because of the shutdown. But the office market has really suffered here. But at the same time, we've seen one of the large office REITs actually announce basically a pre-leased development of a brand new office building, because exactly this flight to quality. We've got tenants and potential tenants in Washington, D.C. who can't find the quality they want, and they're willing to pay for and support new buildings before they'll move into older, less amenitized, lower quality office.
Nicholas, one of our attendees, is asking about near-term views on industrial and life sciences, the life science and industrial markets in the United States. I mean, for so many years running, industrial was really kind of the property type of the year, along with multifamily. Life sciences has been very up and down. What do you guys see there these days? Keith, you want to start off?
Yeah, I guess I'll start off maybe on life science. That has been it's been an underperformer in 2025. My memory is that was also an underperformer last year. And we were talking about supply demand conditions being very favorable for some segments of healthcare, especially seniors housing, just a little while ago. That's not the case today for life science. It's more analogous to office, where you do have elevated availability rates. There's that What's unlike traditional offices, there's been more development in life science in recent years, which has increased those availability rates. And I think just with some of the noise in the background regarding drug development, approval processes, I think demand has been a little bit uninspiring at this point. So, I think that it's been a property type has had some recent headwinds.
Yeah, I would agree. And I think on industrial, I actually, as I mentioned at the top, I actually viewed the performance of industrial for the year as actually quite good if you sort of think about some of the headwinds that they've faced in terms of tariff announcements, the risk of lower demand because of higher tariffs or lowering throughput of many of the products that go through logistics facilities. At the same time that the sector was really working through elevated supply for the last couple of years. And it's important to keep in mind, so if you go back to 2021, industrial REITs were up more than 60%, as we had this wave of this e-commerce boom drove valuations up. We saw a lot of entrants, both mostly in the private space, coming in, doing a lot of building. REITs actually performed quite well. The industrial REITs performed quite well, and then had negative returns last year, and were kind of one of the sort of slower growing sectors as they're working through these supply issues. So I actually think it's a pretty optimistic picture in terms of the supply has slowed down into that sector, and they've been able to keep operational performance up, as well as have positive returns on a year-to-date basis of almost 7% in the face of the many challenges that this year has thrown at them.
Just to jump back to office for a minute, we do have a question from an attendee asking about office conversions. I did in office to residential conversions. I did read recently that New York City has done quite a bit of that, running ahead of the rest of the country. I've also heard that it's really impractical. I suppose if you have a Class B office building, there's really not much in the way of optimism for the future. Is that something? I guess what I'm getting at is, are these retrofits that we're seeing for office to residential, or are they taking Class B and C office buildings and just raising them and then building a new residential mid-rise or high-rise? And do you guys, I realize this, I'm not even sure if you guys have any of this information at hand, but what do you guys think?
Yeah, I mean, I don't know specifically by project if they're all conversions or if there's some raising and rebuilding. But that has been topical. It's not always easy to do those conversions from office to residential, just given layout of buildings, window lines. So not every office building is a good candidate for that, but there has been more zoning flexibility provided by New York. There have been tax incentives offered. And so there has been some uptake, I should say, in the amount of activity that you're seeing on the conversion front. Um, my memory is there's probably about 40 buildings or so that are currently in the pipeline. And I think that's probably around 2% of office stock. Probably actually not too dissimilar of a figure in terms of the contribution that would add to the residential stock as once that converts.
Yeah, and I think the cases where I've seen where it's sort of raise and build has been more likely to be suburban office, where you have more of a campus or office park that may have been maybe underperforming, and that creates the opportunity to build sort of live, work, play, so mixed use, even single family housing. So that's where I think certainly anecdotally I've seen more of that, and I would agree with Keith that there's really been, especially in New York, a meaningful uptick in the number of projects underway. And 2% of stock doesn't sound like a lot, but that can really make a difference, especially in a world where there's not a ton of supply coming in. So taking 2% of the stock can be meaningful in terms of what equilibrium rents end up being.
Mm-hmm. Well, the Fed, I mean, we can't not talk interest rates right now. The Fed just recently cut interest rates by, what was it, 50 basis points. What does that mean for REITs, publicly traded REITs, and real estate in general? Is that enough to move the needle, or was that just I know this is a precarious time. They're trying to not trigger inflation, but at the same time, they want to goose the economy a little bit. The jobs reports have not been great. But are 50 basis points enough to actually create some activation?
Well,
How about that?
sorry to burst the bubble, but it was only 25.
25,
So
25.
only 25 basis points, but it's been hard to have a conversation about real estate the past several years without talking about rates. I think it was, really only a year ago that rate cuts began, but they've been on hold in 2025, and investors have been waiting for them. So I think it's clearly a positive, especially for sentiment. As far as what that does for public equities and cash flows, there's likely to be a bit of an earnings uplift. Any company that has floating rate debt exposure, those costs are going to go down. That's going to be beneficial to cash flow. But the other thing I'd say is, we've looked at this before because it's been so topical. REITs do have a good track record of doing well when the Fed is cutting rates. Every cycle's different, but the track record is that REITs have a good track record of outperforming general equities when the Fed is cutting in the years following. So we think it's encouraging. It's unclear it's unclear how much long-term interest rates are going to change as a result of the cuts. There's fiscal, there's deficit concerns, but I think it provides confidence that we're in a more stable interest rate environment, and that's helpful for transaction markets. That's helpful for underwriting properties, and so we do view it positively.
Mm-hmm.
And
You as well, Tim?
I would agree. I mean, one of the things that we've seen is that REITs can, and real estate generally can perform well really in all different types of interest rate environments, but those transitions can be a little difficult, especially when you're moving from a lower rate environment to a higher rate environment. And that we saw that a couple of years ago, where REITs really underperformed during the rate rise cycle, despite the fact that their operational performance continued to be good, and their balance sheets went into the rate rising cycle really solid, and came out of the rate rising cycle really solid. But still, I think it was sort of hard. It's always hard to fight the Fed, and it's hard to fight that tide of sentiment that goes along with REITs and rates. So yeah, we think rates coming down is only a positive. As Keith mentioned, I think the big question will be, do these short-term rate cuts flow through into the 10-year Treasury, which is really kind of more of a key for REIT debt pricing? Do we see the 10-year Treasury starting to come down? Can we get below 4? Can we get into the mid 3s? I think that would be good for REITs. I think it would be good for real estate overall. And in particular, I think it'll help transactions start to tick up. I think one of the things that we see really kind of holding the market back is the lack of transactions. That is both sort of keeping deals from getting done, but also keeping public and private valuations from converging as we start to see more transactions flow through into appraisals, so we can really get to an equilibrium that will allow both REITs and private real estate to start growing again.
Okay, audience question. Keith, let me have you take a shot at this one. Just envision this gentleman being one of your clients, if you could. He says that many funds are actively diversifying away from multifamily and industrial due to concerns about overconcentration. What are your views on alternative property types in this context? Does this shift inherently introduce greater risk?
Well, John, I don't know if you have the stats handy, but I would say that, that's been one of the things in the public markets that's not a new phenomenon. Relative to the private markets, I think the REITs have much more diversified property exposure. Alternatives are a meaningful portion of the public quadrant, or the public investment case for real estate. Pretty diverse in terms of the sectors. We have healthcare, we have wireless infrastructure or tower REITs, we have data centers, we have self-storage. So while I think you've seen, if you look at transaction markets in recent years, they have been dominated by multifamily and industrial transactions. I would just say that the public markets are much more diversified, and we think are offering it's an interesting segment because it includes a lot of property types that you don't get in a more traditional private real estate fund.
And Keith, I'm going to sort of, since you called an audible, I'm going to catch your pass. I'm going to show a slide here that I happen to have on my laptop, and here you can see just a comparison, something that we tend to have in our deck, just an ability to compare, for example, what's in Odyssey, which we just use just because we can see it, where you can see 90% of the value in sort of the traditional 4 property types. Whereas in the REIT space, where you have basically 60% of the market capitalization outside those traditional 4 property types, with large exposures in healthcare, data centers, telecommunications, self-storage, and then lots of innovation on down that list in gaming, lodging, single-family homes, manufactured homes, etc. So I would say I agree with the question that we are seeing a lot of funds moving in that direction. One of the things that we talk to institutional investors a lot about is, as they want to sort of think about modernizing their real estate portfolio, how because REITs are already in this space. Data centers is a great example. You could go to a fund, get data center development. You could go to a REIT and get data center rents, plus with a development kicker. So yeah, we think that is definitely happening, but we think for institutional investors, REITs can be a really important part of how you change that portfolio.
Another audience question: does your life science view change given the 100% tariff announced on the branded pharma sector? In other words, if you're going to be importing drugs from overseas, that you have 100% tariff slapped on top of them. Make them in the U.S. and there was no tariff. What does that say about the life sciences sector? Do you see any impact there? John, you want to start with that one?
Yeah, it's an interesting question. I have to say it's not something I gave much thought to when I saw that announcement. My knee-jerk reaction is not a lot of effect, because when we think about who's in those life science buildings, it's the R&D teams. So it's a lot of startups. There's a lot of private equity supported tenants in those spaces. So it's not going to be so manufacturing focused as it is going to be that R&D focus. Now, could the tariffs have a secondary, sort of second derivative effect on how much R&D you do? That I gotta, use the whiteboard behind me and do some math and figure it out. But for now, I'd say no, for me, no first order effect.
Mm-hmm. Okay.
There's certainly uncertainties there. Maybe just one thing I would add is I think that headline of drug pricing and the elevated tariffs is probably more alarming than it needs to be, just because when you think about the vast majority of drugs that are imported into the US actually come from the UK, Europe, and Japan, and we have framework deals on tariffs with those countries that so those drugs will be at lower rates, and so it's again that the headline is probably more alarming than it really is.
We have another attendee who's asking about cold storage as differentiated from industrial real estate. It does say that by stock performance for the two U.S.-centric cold storage REITs, the performance has been quite poor this year. Can you comment on the outlook for cold storage going forward?
Yeah, I can start. I can start. I think the outlook is admittedly cloudy. And why I say that is we've had demand weakness for that property type, and it's coming through. You can look at USDA data, but it's been consistently weak now for probably the past 18, 24 months. And investors have been waiting for that demand to show more positive trends. And frankly, it's been slower to show those than investors would have hoped for. So the demand weakness is difficult to predict. It seems like a lot of food manufacturers are moving more to just in time, and so there's just some inventory rationalization, and that's put some pressure on occupancy levels, both leased occupancy and physical. So yeah, I would say that there's just some uncertainty, and we're asking the same question about kind of when will those green shoots emerge that we're seeing signs of greater stabilization.
Hey, John Worth, why are U.S. multifamily REITs underperforming? This is a question from one of our audience members. We keep hearing about housing shortages, housing crisis in the United States. You would think that every one of these properties would be packed to the gills and doing very well. Why the underperformance? What's the reason for that?
Well, and I think if you look at the multifamily REITs, you'll see that their occupancy rates are quite good. I think the underperformance this year had more to do, in my mind, with concerns about the macro economy and growth. As if you get into a slowing economy, that's where you see household formation slow down. You could stay in mom and dad's basement versus heading out and getting your own apartment. And so I think it's more a reflection of future rent growth if we have a slowing economy.
Gotcha. Okay. Keith, we're moving into the final quarter of the year. What would you say has been the biggest surprise for 2025 in your mind? Is there a category that you were expecting to perform much better and has surprised you, or vice versa? Maybe you expect to be a laggard, and there it is, kind of setting the pace.
Yeah, I mean, John kind of touched on this earlier, but I'd say the biggest surprise has been just the general equity markets power through mentality. I mean, the reality is this macro environment that we've been in for 2025 has been pretty complicated. There's been a wall of worry in different areas, whether it's tariffs or monetary policy, labor markets, geopolitics. But really nothing has killed investors' confidence. And so, there's AI enthusiasm has remained. We've seen corporate earnings hold up quite well. Debt markets have held up quite well. Transaction markets in the real estate markets, while they're not at the levels of 2022, they're still on a recovering trend. We've seen the consumer hold up pretty well. There's been pockets of strength and weakness in consumer spending, but overall spending has been pretty solid. So I don't know if some of the story, I don't know if the story has been fully written on some of these worries, but um, I would say that just the level of resilience in the market has been a bit surprising. I think thinking about it more specifically from a real estate perspective, John mentioned industrial, just how that's performed in light of tariff headlines, which, you know, I, tariffs are at the highest level that they've been at in nearly 100 years. And so even if you would have given me that headline January 1, I, you know, I would be surprised that industrial would be doing as well as it has.
Hmm. Hey, John, I've asked this question of you before during some of the past webinars, but I think it bears asking again because it's interesting. Nareit has been tracking institutional investor use of REITs. How are those statistics tracking these days?
Yeah, it's interesting. We look at a lot of different data sources. Preqin is one of them, a number of other sources, try to understand, how are institutional investors using REITs. And what we're seeing is that the use of REITs by pension funds, sovereign wealth funds in the U.S. in particular keeps ticking up. So today we estimate that about 50% of U.S. pensions are using REITs as part of their real estate strategy. Virtually 100% would have them in their equities. About half are using them in their real estate strategies, and that accounts for about 70% of the pension assets in the U.S. So what we see is that there's a as you go up the size, up through the sizes, you'll see the larger pension funds are actually more likely to be using REITs, again, in conjunction with private real estate in their portfolios. And we're seeing the same globally. We've been doing a number of case studies. We just released a couple case studies in the last month and a half, two with Dutch pension funds who use public and private real estate together in their portfolio to really have a combined portfolio that gets access to a broad range of property types. And then another one showing how a active manager has been working with a large sovereign wealth fund. Again, more of an alpha creation strategy using REITs, but layering the REIT strategy onto their private real estate strategy. So, we think that that's kind of one of those emerging themes. Sort of not necessarily having the REITs sort of as a passive bucket that sits next to the private real estate, but really integrating public and private real estate into a single strategy.
Mm-hmm. One audience member is asking if the data center REITs are most focused on hyperscale data centers. Is that where the development and ownership is, or on edge data centers? I'll make that one a jump ball, whoever wants to go for that one. Now, my understanding though is, hyperscale data centers are the big ones that are being run by Meta and Amazon and Google and so on. Is that the case? And where's the area of concentration, or is it more towards edge computing or edge data centers, I should say?
Yeah, it's a bit of both. So, we do have public companies that are more focused on retail co-location space that's really targeting leasing to demand that's focused on connectivity and latency. And we also do have data center companies that have larger exposure to those hyperscale cases. Again, I mentioned this earlier, but I think the the REITs have been disciplined in staying in the primary markets, and so hyperscalers have been building their own data centers in other locations. There's been private data center development in other locations, but REITs have remained pretty consistent about where their strongest interest in is. And to your question about ownership versus development, it's a bit of both as well. So large owned portfolios, but they also have active development pipelines that are creating enormous value today. Some of the largest profits are in data center development.
Mm-hmm. John, I always ask you about that public-private valuation divergence. Has the opportunity to take advantage of this disappeared, or through some arbitrage, or do you still see a divergence there between public and private real estate?
That divergence, the gap has closed, sort of from we had a very large gap back, at the end of 2022. It's closed a bit as, REIT cap rates have come down, private cap rates have crept up, but it's still a meaningful gap. Today, if you compare just REITs and private cap rates, the delta or the gap between the two is about 130, 140 basis points. So, and when we look back through history, that averages in times where you don't have divergence at about 50 basis points. So there's still really a meaningful spread before we would say that public-private valuation divergence has closed. One of the things that I think is really interesting, and one of my colleagues just wrote a market commentary on this, it's on the Nareit website, is if you overlay what's happening with transactions. So most of the times when we talk about private cap rates, we're talking about appraisals. If you overlay the transactions data, what you see is that the cap rates on transactions are almost directly on top of the REIT cap rates. So we think that that's suggestive of, as we see more transactions take place, we're going to see more convergence, because we'll see those transactions actually getting into appraisals, and so we'll see those markets converge. But we still think there's a really meaningful opportunity to use REITs tactically or opportunistically to kind of take advantage of that valuation divergence.
Mm-hmm. Okay. Hey, Keith, and I'm going to want you to answer this one too, John. But Keith, what do you predict? Well, to begin with, 2025, what is the property type of the year, do you think, by the time we're done with 2025, will be seen as a property type of the year? And just looking ahead, what do you think will be the property type of the year in 2026?
Yeah, so for 2025, I think the healthcare group has a pretty strong lead. It's going to be hard to catch them. We're pretty optimistic about healthcare and that, having some legs. We see occupancy above pre-COVID levels, but we still see significant room for occupancy gains in healthcare. We think the story is going to move more from it's still going to have that occupancy growth component, but it's going to shift a little bit towards stronger pricing power, rental growth. And one of the other unique things that property type has is it does have a fair amount of operating leverage. And so, the incremental margins, once you get your portfolio above 90%, the incremental margins can be pretty interesting. So, we think internal growth looks attractive. We think it looks durable for years into the future. And then you layer on kind of an exciting external growth piece as well. It's getting more competitive out there. There is more capital targeting the asset class, but we think the public companies have an attractive cost of capital and will get their fair share of opportunities out there. So that'd be one. I'll let John go.
Yeah, what do you think, John?
I agree with Keith on healthcare for 2025. They're sort of putting up Chicago Bulls glory days kind of track record. So I don't know if anyone's gonna catch them in the playoffs. But I think for 2026, I'm going to throw a little curveball. I think retail could become increasingly interesting. Right, it's a sector where operational performance has held up. We've seen in the different sectors of retail, we've seen changing tenant bases, and we haven't seen a lot of supply coming online. So, I mean, if we enter into 2026 and we see the macro picture a little less cloudy, sort of, sort of fewer of those. I mean, Keith, I think you did a nice job enumerating the short list of uncertainties. But if we can shorten that list a little more and see the consumer feeling a little healthier, I think that's a sector that we could see really good returns in.
Yeah, I've been hearing that for years, no new building, old retail torn down. There's been a shortage of good retail property to occupy. Not only that, but there's also just the technology. They've really caught on to the technology. The whole omni-channel thing has gotten really powerful. And the whole online and brick and mortar marriage, rather than a competition, becoming a marriage, and doing very well with that. So I talked to some executives that said this year would be retail property type of the year, but looking ahead to 2026, no reason why it might not be the one for 2026. It's interesting because when you think about it, it used to be kryptonite to investors. Everybody was just saying stay away from retail. It's bad juju. We have Lillian in our audience, and she's asking, as private credit grows and starts to outpace traditional institutional lending, what implications are there for seeing, um, uh, implications are you seeing for pricing and risk allocation in commercial real estate deals, both at the senior and mezzanine levels?
Well, I just don't, there's already lots of private credit in real estate. I think this is one of the really interesting distinguishing features between the REIT model and other models of how you finance real estate. Today, about 80% of REIT debt is unsecured debt. That is, it's issued as corporate bonds in the corporate bond markets, and the yields on that debt is really quite competitive, quite a bit below what you're going to find in private credit, and it's actually, I think, been one of those features of the REIT model that is providing more and more flexibility in terms of how you operate. We've got a piece coming out that's a bit of a primer on unsecured debt and REITs, and one of the amazing things is we're seeing REITs go from sort of concept to execution on a debt issuance in less than a week. So when they, when the spreads look good and when the 10-year treasury is in the right spot, REITs are able to execute on doing a refinancing or even some new financing for growth very quickly and at really competitive rates. So I do think private credit is going to continue to grow and be an important part of the overall real estate infrastructure, but I think less so in the REIT space because they've got access to the unsecured debt market.
Keith, any thoughts on that?
No, I mean, I agree with John that hasn't been a vehicle that public REITs have used as much, and I think it really speaks to the unique access that they have to the unsecured markets, which we have seen an uptick in issuance in the past couple months. And there's several examples of REITs issuing capital at sub 5%, and so pretty attractive cost of capital for REITs today, and access is there.
Definitely.
Hey, one final question for our audience. Heather's asking, what are U.S. hotel cap rates now? John, do you have, or Keith, if you've got that at your fingertips? So, I would just harken back to pre-COVID. Hotels, the fundamentals on hotels have never been better in hotel history. And that was in the throes of competition with Airbnb and VRBO and so on. Then COVID came along and changed a lot. But the hotel market's really come back, has it not? And what are we looking at for cap rates now? You guys know?
You know, that is not popping up on my laptop here quick enough to give a real-time answer, but I'll be happy to send along at least the US hotel REIT cap rates directly.
I don't have it on the private market side, but I think the public REITs are probably trading at implied cap rates in the upper single digits, call it 9 to 10%.
All right. All right. Well, listen, we're out of time. Our time is up. John Worth of Nareit, Keith Bokota, Principal Asset Management. Thank you for sharing your data and your insights. And to our audience members, of course, we thank you for your attendance and participation. Please be apprised that our next REIT webinar is scheduled for January 13th. Keep an eye out for the publicity and registration information on that one. We obviously hope to see you there. So on behalf of IREI and Real Assets Advisor Magazine, this is Mike Consol wishing you all a good day and a terrific fourth quarter of 2025.